Nearly 1 in 3 Gen Xers with 401ks hold company stock inside their employer-based plans. But most have no idea that mishandling that stock at retirement or separation of service could cost them tens of thousands in taxes. Today, we're going to break down how Net Unrealized Appreciation, or NUA, helps you retire early, unlock tax-efficient income, and keep more of your money. Let's chop. Hi, I'm Dr. Preston Cherry, founder and CEO of Concurrent Wealth Management, where we help you align your life and money so you can live your wealth your way. And if you like what you see, feel, and hear on the show, hit that like and subscribe button and leave a comment. We always want to hear what's on your mind. Here's what we're seeing more and more with Gen X professionals right now. You've built up meaningful wealth in your 401k, and a big chunk of it is in company stock. But when it's time to retire or roll things over, most folks treat it all the same. They lump it all into an IRA, and that's when they lose a golden opportunity. So let's talk about what you can do instead. NUA lets you treat the growth of your company stock differently for tax purposes. Instead of being taxed at ordinary income tax rates, which can climb above 30%, you could pay long-term capital gains rates, which are usually 15 to 20%. That tax difference matters. Let's look at a common example we see here at Concurrent Wealth. Let's say Heather is 55 and retiring. She has $60,000 in employer stock inside her 401k. Over the years, it's grown to $260,000. If she rolls that into her IRA, she is taxed on the full $260,000 at her income rate, say at 35%. But if she applies NUA, she only pays income tax on that $60,000 on her basis. That tax difference matters. Let's look at a common example of what we would see here at Concurrent Wealth. Let's say Heather, 55 and retiring early. She has $60,000 in employer stock inside her 401k, and over the years, it grows to $260,000. If she rolls it into an IRA, she is taxed on the full $260,000 at her income rate at, say, 35%. But if she applies NUA, she only pays income tax on the $60,000 cost basis. The $200,000 in growth, that gets taxed later at the capital gains rate when she decides to sell. This move gives her options. It can fund early retirement, help her avoid tapping IRAs early, and limit unnecessary tax pressure. It also keeps her from stacking up income in retirement, which happens fast when Social Security, pensions, and RMDs start rolling in. NUA creates a new lane that's more optimal for people holding stock in their plan. Here's where most people trip up, though. The strategy itself. To use NUA, you have to get 3 things right. 1, the triggering event. You need a life milestone that qualifies. You've separated from service, turned 59 and a half, become disabled, or in some cases passed away. 2, you must complete a lump sum distribution. You've got to distribute your entire retirement account in the same tax year, not just part of it, all of it. That doesn't mean cashing it out. It means moving everything out of the plan in one motion. And 3, know where everything goes. This is key. The non-company stock, mutual funds, bonds, all the rest gets rolled into an IRA. The company stock must be transferred in kind to a brokerage account. You don't sell it. You don't move it into the IRA. You transfer it as is straight to the taxable account. Let's get into another example. Let's bring in Derek. Derek is 61. He's retiring, holds $500,000 in company stock. His cost basis, $100,000. Here's what he does. He retires, check. He distributes his account in full, check. He rolls everything except for the stock into an IRA, check. He moves the company stock directly into a brokerage account, check. Now he pays ordinary income tax only on the $100,000. The $400,000 in growth gets taxed at capital gains rate when he sells, not now. And that difference, it could save him over $75,000 in taxes. Plus he rolls all of that money out of RMD down the line. One wrong move, though, like rolling over the stock into the IRA, and it's over. The NUA window closes and there's no do-overs. You only get one shot per triggering event, so don't act until the strategy is clear. What's the biggest mistake we see people make? Well, people roll everything into an IRA without even looking at their company stock. They default to simple, but in this case, simple may be expensive. Once the stock enters the IRA, it's locked into the income tax treatment. That stock may have grown for 10, 15, 20 years, and now you've handed it back to the tax man at the highest possible rate. Do I have company stock in my plan? Has it appreciated a lot? Am I near retirement or turning 59 and a half? If yes, you owe it to yourself to explore NUA. It could save you more than just money. It could give you a strategy, control, and time. We've walked clients through this dozens of times, and when it fits, it's one of the most elegant tax moves available. It can help you fund early retirement, reduce future RMDs, and give you the space to make life decisions on your own terms, not the IRS's. All right, that's what I got for you. If you want a deeper dive into this topic, jump on over to the Concurrent Wealth website. Our blog breaks this down even further. Before we go, let me leave you with this. My granddaddy used to say, I know you can lift that heavy bag, but is it smart? A default rollover is easy, but that easy button can cost you dearly. Be thoughtful, be strategic. You've spent decades building this wealth. Make sure your exit plan does it justice. Build a strategy that aligns your life and your money and secures the life you value most. Until next time, we'll chop soon. Cheers.